CIM. Okay. CIM, this is a 2015 December question of performance management and control. Section C question. It will be for 20 marks. Cardale Industrial Metal Company is a large supplier of industrial metal. Okay, this is a very huge question. Let me read the requirement first. So, calculate the appropriate closing return on investment on which the payment of management bonuses will be placed. Okay, so the bonuses are dependent on the return on investments. Briefly justify the figures used in your calculations. And note there are 3 marks available for calculations and 2 marks available for discussions. Okay, so Cardale Industrial Metal Company is a large supplier of industrial metals. The company is split into two divisions, Division F and Division N. Each of the divisions operates separately as an investment center, with each one having full control over its non-current assets. In addition, both divisions are responsible for their own current assets. Both divisions are responsible for their own current assets, controlling their own level of inventory, cash, and having full responsibility for the credit terms granted to customers. Okay, and the collection of receivable balance. So we this information is all related to controllable assets and controllable expenses or revenue. So, similar, each division has full responsibility of its current liabilities and deals directly with its own suppliers. Okay, each division manager is paid a salary of 1,20,000 per annum plus annual performance related bonus based on the return on investment achieved by their division for the year. Each division manager is expected to achieve a minimum return on investment for their division of 10% per annum. If a manager only meets 10% of the target, okay, they are not awarded a bonus. However, each of the whole percentage above 10%, okay, which the division achieves for the year, a bonus equivalent to 2% of the annual salary is paid. Okay, this is all. This information will be useful for calculation of bonus, which is dependent on the ROI. Various other information is given. Okay, during the year ended 31st August 2005, Division N invested 6.8 million in new equipments, including a technology advanced cutting machine. All right. Then what else? Division F has made no investment during the year, although its computer system is badly in need of updating. Division F's manager has said that they have already had to delay payments to the supplier because of limited cash, and computer systems will have to wait, although the cash balance at Division F is still better than that of Division N. Mm-hmm. Okay. Now, let's calculate this CIM related information. So, first of all, we'll calculate the return on investment for Division F and Division N. ROI for Division F. What is the controllable profit? It has already said that everything is controlled, right? Sales and everything. Now we have sales, and controllable profit is sales are controlled by the division, so the profit is also being controlled by them. So the controllable profit was 2,645. We will not look into this thing, because this is something apportioned from the controllable profit from of the division. So there are some profits which get transferred to the head office. It's kind of a net income pickup which is done by the head office. So this is not relevant for performance management perspective. And this is basically a net income pickup which is being done. So the profit earned is holistically controlled by the division and not by the head office. So your controllable profit will be 2645. And what about the controllable assets? So net current assets, they are all controllable by the divisions, even the inventory, cash and trade receivables, yes. And we will also reduce the trade payables. Everything is controllable by the divisions, which has been mentioned in the question. So I'll calculate the net assets, which will be 9,760 plus 2,480 minus 2,960, and it will give me 9280. Let me calculate the ROI. 2645 divided by 9280 into 100, that is 28.5%. Okay. Now for division ROI, for division N, what is the ROI for division N? For division N, my sales are 8,700. But okay, the controllable profit is 1,970,000. So the controllable profit is 1970 divided by assets, net assets. So 14,980. We'll do the same thing for division N as well. Plus 3260 minus 1400. So it will give me a net assets of 16,840 into 100. So 1970 divided by 16,840 into 100. So it is giving me this much. Just wait. It's actually giving me, I can say it's 70. Yeah. Okay, so this is how. Now how will I calculate my bonus? So I have calculated my ROI, which is given, which was asked over here. Now describe whether the ROI, discuss whether the ROI is providing fair basis for calculating the manager's bonus and the problems arising from its use at CIM company for year ended 31st August 2005. So how will we calculate the ROI, the bonus? First we need to calculate the bonus as well. How will we calculate the bonus? The information for the calculation was given above. So the divisional manager is paid a salary of 1,20,000. 1,20,000. Okay, 1,20,000 per annum plus annual performance related to bonus based on the return on investment achieved by the division for each year. So the divisional manager is actually expected to earn a ROI of 10%. So the ROI of 10% is the target. Okay, so if a manager only meets 10% target, okay, sorry, so 10% per annum, if a manager only meets 10% target, they are not awarded. So anything below 10%, they are not awarded any bonus. However, for each of the whole percentage above 10%, each of the above 10%. So okay, so B part, bonus for division F each of the what is the ROI? ROI is 28.5. So extra or overachieved. I can say the target was for 10%, right? So the overachieved ROI is how much? 28.5 minus 10%. So it is 18.5%. It has overachieved by 18.5. So it is said for each percent above 10%, a bonus equivalent to 2% of annual salary. Okay. So bonus of salary is 2% of 1,20,000, which is 2,400. So the actual bonus earned by manager is 2,400 into 18.5, because it was written that this 2% of the annual salary needs to be multiplied by each percentage which is overachieved by the 10%, which is over and above the 10% of the ROI. So 2,400 into 18.5 is okay. So it was saying whole percentage. I have included 18.5, but it is whole percentage. So 0.5 is not whole, right? So we'll have to ignore it. Okay. So the answer is 43,200. Now what is the bonus for division N? Bonus for division N. How much is the bonus earned for division N? Again, the ROI was 11%. ROI was 11.7%, and the target was 10%. So overachieved by 1.7%. So the whole percentage which will be considered will be 1%. Therefore, bonus earned by manager of division N will be only 2,400, which is very less, right? Okay, so second part is not done. Actually, I've ticked, but it is not done. We need to discuss that further. So I think I have okay, what I did was I cropped the second part of the first. So this was actually not this bonus was part of A part only. So the A part had, first we need to calculate the bonus, and it had 2 questions in it. So only A part is completed right now. The second the second part got cropped by me. Please refer to the Kaplan kit for that. B, discuss whether the ROI is providing a fair basis for calculating the manager's bonus and problems arising from its use at CIM for the year ended 31st August 2005. So it is very much clear that it has some problem, because this is not appropriate way of giving bonus or allocating bonus, because over here I can see that division M's manager Division M's manager is only getting a bonus, getting a bonus of, Division F's manager is getting a bonus of 43,200, whereas Division N is on, the manager of Division N is only earning a bonus of 2,400. So this way, the manager of Division N might get demotivated. So I do not feel that this can be the whole purpose, this can be the whole way of calculating. But let's read, this is discursive. So manager of division N will be paid a far smaller bonus, yes, I said this at the very first place, than the manager of division F. This is because the large asset base on which the ROI, okay, we can see what is the asset base, yes. So capital employed seems to be a bit large for division N. So the denominator will be bigger than the numerator. If the denominator is bigger than the numerator, then our ROI will be less. So for division N, the ROI at the very first place was less. You can show that calculation as well. So it is very surprising that they did decide to invest. Okay, so some investment decisions were also discussed, right? So during the year end, Division N invested 6.8 million in new equipments, including, yeah, so although they had invested in Division F had, okay, Division, so N. So this investment was related to Division N. You can also mention that your investment or your capital employed got increased because of this information which is given over here, which is expected to increase, even though the productivity increased by 8%, but your return on investment is has been reduced. But again, this investment was made during the year end, I believe, during the year ending, right? The year ending, or during the year, not the year end, yeah. So during the year, yes, okay, so it was made, but the ROI comparatively is less than, right? The return on investment is comparatively less. So even for the division as a whole, this investment, I think I cannot say that it is fruitful, even though they have made an additional return on investment in this division N. Sorry, they have made an investment of 6.8 million in division N, but the returns are not as per the investment. The return is quite less. Okay, again, it depends if the investment is done during the year end. If it's done during the year end, maybe the returns could be seen next year, and it can be possible that next year the returns might improve, but there is no clarity given in the question whether this investment is done during the year or at the year end. So if it's during the year, so it is not the return, they are not that much attractive. They are not they do not seem to be in line with the amount of investment made in the technology. Ideally, the return should have been more. So let's read. Division N's manager is being penalized for making decisions which are best in the interest of, yeah. So Division N's manager made this decision, okay, you invest in Division N and make this, you know, uh, investment of 6.8, and that was in favor of the division, that was for the Division N's benefit. But then this in turn led to the decline in Division N's bonus, right? Because the bonus was dependent on the ROI, and in future, manager of Division N might feel demotivated, that he or she might think it would have been better if I had not taken, these okay. So Division F trade payables figure is much higher than Division N, and this plays a part in reducing the net assets. So basically, the controllable profits is calculated. It is I think this can be this is very easy, and this can be read by anyone and attempted. Let's jump on to part C. Briefly discuss the strengths and weaknesses of ROI and residual. So, okay, this is really important. This is part of a theory thing, and we can discuss this. Briefly discuss the strengths and weaknesses of the return on investment and residual income as methods of assessing the percentage of divisions, and explain two further methods of assessment of divisional performance that could be used in addition to ROI or residual income. So, okay, so ROI is expressed as a percentage and is more easily understood by non financial managers, right? So, ROI can be used to compare performance between different sized divisions or companies. It is also necessary to know the cost of capital in order to calculate ROI. So the ROI may lead to dysfunctional decisions. For instance, if a division has a very high ROI of say 40% and is considering a project with an ROI of 30%, which is uh, which is still well above the cost of capital of say 10%, then the project should be accepted as it provides a return well in excess of the cost of capital, right? So if your cost of capital is less and the return on investment is high, so the obviously the decision would be taken to accept the project. So the division may quite possibly reject the project, however, as when added to its acquisition operations, existing operations, it will reduce the ROI from 40%. Now, using residual income as performance measure should ensure that division make decisions which are in best interest of the group as a whole, and should eliminate the performance outlined in the previous paragraph. So, residual income. Okay, both residual income and ROI improve as the age of the asset increase, and both provide an incentive to hang on to each possibility inefficient machines. Other methods of assessing that could be in addition to ROI or return on investment is expected value added, to similar to the residual income, except that instead of using book values for profit and capital employed, the figures are adjusted to reflect the true economic value of the profit and of the capital employed. Then the balance scorecard is another way, uh, yes, which will look into the financial performance, and perhaps using residual income or ROI. It only sees as financial performance and the customer perspective, or the internal business perspective, and learning and innovation perspective. These three are ignored. So balance scorecard would include give you a holistic picture of the performance, and whereas residual income and ROI would give you only such will give you information for financial perspective only. And also, but at the other hand, if there is a non-financial person which does not have much knowledge about the ROI or the cost of capital, I think balance scorecard can also be one of the way due to which because of which the performance can be assessed. There are some financial managers, non-financial managers can understand, because ROI is something, a very easy way through which a non-financial manager can understand the performance. But 80% chances are there. Rest for the 20%, I can say yes, the balance scorecard is definitely beneficial for that. So one of the weakness of both ROI and residual income can be this as well. And one of the advantage of residual income, I would say that residual income as a performance measure should ensure that divisions make decisions which are in the best interest of the group as a whole. Okay, so and should eliminate the problems outlined. So what are the problems outlined in the previous paragraph which I read was they I'll read this previous paragraph. ROI may lead to dysfunctional decisions. Why ROI may lead to dysfunctional decisions? For instance, if the division has a very high ROI, say 40%, and is considering the project with a return on investment of 30%, so which is still well above your cost of capital of say 10%. So there is any project which is giving you an ROI of 30%, but the cost of capital of that project which is giving you an ROI of 30%, the cost of capital of that project is 10%, and there is another project which is giving you 40% return on investment. So any manager who a non-financial manager, as I mentioned, because I mentioned this earlier that it can be understood, it is easily it is a very easy way uh, which non-financial managers can understand, but a non-financial management may not assess the way we are discussing right now, because the in project which might give you 40% return on investment, that might get selected, and the project which is earning ROI of 30% having cost of capital of 10% might get rejected. So the non-financial manager might not see the 10% cost of capital. It might be the case that the project which is giving you return on investment of 40%, that might have a higher return cost of capital. So the non-financial manager would not assess in this from this perspective, right? So this is not this can be this can lead to dysfunctional decisions. So the division may quite possibly reject so this was all. Okay.